CNBC TV18, celebrating 15 years of leadership.
Hello and welcome to this CNBC TV18 special, Crystal Ball 2015. It's been a rocking start to 2015. Global volatility, a surprising rate cut from the Reserve Bank of India in terms of timing, poor FII flows, excellent domestic flows, and the big question whether 2015 can be an encore to what's been a cracker of a 2014. The House of Macquarie will speak its mind today about how this year might shape out, and to do that I've got with me Bharat Rawala, Managing Director and Head of Macquarie Securities India, and Rakesh Arora, Head of Research at Macquarie. Gentlemen, thank you very much for joining in. Bharat, I have to start off with what your expectations is with the interest rate landscape, because that's recent news. How much of a tailwind can it be for the stock and the bond markets? Do you see it as a one-off, or do you see it as a serious start to a down cycle in interest rates throughout the year?
I think the rate cut is obviously is very welcomed. It's a surprise in terms of timing. But personally, I'm not surprised, because I think our RBI governor he's a sharp guy. He knows what he's doing. He doesn't need a lot of guidance and market talk to dictate how he wants to cut rates. So it's very welcomed. Markets are rallying this morning, which is good. As a house, we expect another 75 basis points cut over the next 12 months. But clearly very welcomed by the markets, very good for the financial stocks.
I think just 2 months back, consensus was at zero rate cut. We were at 50 to 75 basis point. We have moved to 100 basis point. I think consensus is now 50 to 75. So I think there's a little bit of catch up which market is doing in terms of expectation, and 25 basis point is just the start. So there's further easing likely on the cards. And now we have got two hands trying to push Indian economy. Government is already there. Now we have got RBI governor also coming in. So probably things pick up dramatically in the year ahead.
So are you upping your targets for the full year, Rakesh, or do you think 2015, because of the slow pace of improvement in growth, might be a modest year in terms of returns compared to 2014?
Well, we are forecasting around 19% returns for the market in 2015. So our Nifty target is 9940, and compared to last year, it is a little bit of a modest increase that we are projecting. But remember that last year was a turnaround year for Indian economy. We had a stable government after 20 years, and that really led to the re-rating. So out of 35% odd returns which market gave last year, 15% was re-rating, the PE re-rating that we saw in expectation of better growth. So you can't expect re-rating to happen every year. It's already happened. And now it will be back to earnings growth. So, 19% return is consistent with around 19% earnings growth that we are forecasting for the market for next year. And compared to, the other markets in the region, I think India is still very well placed. So India is among the top 3 countries in the region that we like. In addition, we like China and Philippines. So India is among the top 3 countries we are recommending investors across the region.
Bharat, where does it leave foreign inflows? Because December was a weak month for foreign flows. We saw selling of about 4,000 crores. Not to take anything away from the huge inflows that we got through 2014. And even 2015 has started on a tepid note in terms of flows. What would you put it down to, and do you see that reversing anytime soon?
On foreign flows, I think December being a slightly quiet month is not surprising. Historically, it is a quiet month. But having said that, in terms of business, it was a very strong month for us, and I think for the street as well. In terms of flows, we're into the second week of a new year. People are still sort of assessing how they want to place their bets. So I'm not surprised that it's off to a slightly slow start, but it's not an anomaly. So I think we've got the rate cut today, which is a catalyst, and the foreign investors are really looking towards India, and they're looking for catalysts. Rakesh talked about earnings growth. So I think what we're looking to see is whether we have top line growth. We need to get this quarter's earnings under our belt. And then I think you will see the inflows coming in. I mean, there is definitely still a lot of interest. Clients are still talking about India. It's a place they want to be. So I won't be surprised that if you see the inflows picking up post-results.
So, but in terms of just figuring out where the outflows may have come in from, is it redemption because of a general global risk-off mood, redemption in emerging market funds, or would there be different kind of investors who might have lightened up over the last 6 weeks?
I don't think that we've had redemptions in funds. That's nothing that we've picked up, unless, Rakesh, I don't think we have, right?
See, last 2 quarters, the global liquidity has been going down quite, dramatically. And, that has been one of the reasons that some of the money has left towards US shores, and risk-off trade was on. But for 2015, we are very confident that, liquidity position globally would ease. Bank of Japan has already done a little bit of easing, and they might do more. ECB is the next one, and if required, I think US Fed will also come in and chip in probably QE4 if things don't really recover. So we are pretty optimistic about liquidity picking up globally, and that should really stabilize the FI inflows that should happen in 2015. Meaning 2014 was a little bit tepid compared to what happened in 2012 and 2013. I see no reason why 2015 would be any worse. We should get at least $18 to $20 billion of inflows from FIs this year.
But when you speak to your clients, Bharat, global clients, do you sense that they're apprehensive because of what might happen in the events at the end of January, stacked up at the end of January, the Greece elections, etc.? Do you see that injecting any major volatility in global equities in the next couple of weeks at all?
I think there will be some volatility with Greece, with the potential discussions about them leaving the euro. But at the same time, crude is helping alleviate a lot of the global sort of macro headwinds, so to speak. And I think India is slightly isolated in its own way. But there is, I don't know if you picked this up, but the World Bank cut their sort of global GDP growth rates yesterday. Russia, I think they were looking for a 1.5% growth in 2015. They've got it down to negative 2.9%. On the Eurozone, they had 1.8% growth forecasted in 2015. They've cut that to 1.1%. So I think there are a lot of headwinds in Europe in 2015. I think the US is strong. EM cannot be sort of put into one bucket because BRICS in itself, with Russia really out of the equation, doesn't stack up. So India is looking good, but we need to see some top-line growth. We need to see some activity from the government that makes investors comfortable about where India is over the next 3 to 5 years. So the jury is still out, but I think we're hearing and seeing good things out of the government, but I think our investors need to be a bit more reassured. But there are headwinds, and we can't get away from what's happening in Europe.
Coming back to the global aspect, Rakesh, the other big thing over the last few weeks has been the virtual collapse in the commodity complex. First it was crude, and more recently copper. What would you attribute that to, and what are the key takeaways from both a macro perspective and even a micro perspective for Indian investments in terms of portfolio allocation?
So see, a strong dollar normally is coupled with falling commodity prices. Because the other currencies depreciate and the cost of production actually comes down. This time around there's another big event, which is oil, and remember that oil is one of the big components for mining costs, and given that oil is a new normal, we have actually overnight cut our commodity forecasts across globally, because now we think that the cost curve actually moved down sustainably to a lower level. So one, there is oversupply in the market, which was there for the last 2 years, but now one, there's as I said, liquidity tightening in the last 2 quarters, so that is there's unwinding of financial positions in the commodities, plus now the cost curve itself moving down, so that is all feeding into one into another, and commodity prices have come down. For India per se, it is good news, and this is one of the critical reasons that we are positive on India right now. oil prices fall and commodity prices fall have solved a lot of India's problem, which would have been difficult otherwise, like inflation and fiscal deficit. So, we remain positive on India. In terms of positioning for India, you have to be, playing two major themes out there. One is interest rate cut. So you've got banks, autos, etc., which really benefit out here. The second is infrastructure build. Because of all this fall in subsidies, etc., government will be in a much better position in the budget when they come out to allocate more money for infrastructure spend. They've also raised the excise duty, etc., on oil to fund road projects. So I think infrastructure build is the second big theme which will play out in 2015. We are pretty gung-ho about three sub-sectors out there. One is roads, the other is railways, and third is power transmission. So these are the sub-sectors where we are looking for, a major impetus from the government this year. And, industrial companies, banks again feature very well for playing this theme. So overall, we are very bullish on banks, autos, and industrial. These are the three critical sectors where we are strongly overweight.
At this point, a quick break. We're back with the Macquarie top team in just a minute.
CNBC TV 18, celebrating 15 years of leadership.